Hi, I'm Mr. Simons, and we're continuing our look at ratios in business studies. In this video, we're going to look at financial ratios with a focus on gearing ratios. So this is for the New South Wales Business Studies HSC syllabus. I'll put a copy in the show notes if you want to double check whether this is the right content for where you're studying business studies. Anyway, let's get stuck into it. So we're talking about gearing ratios. So if we are, let's get a bit organized here, Mr. Simons. So we're talking here about gearing ratios. And so gearing is a kind of an odd word, but when we're talking about gearing, what we're talking about is debt. That when a company is heavily geared, that it is heavily indebted. That's a kind of bit of jargon that we use in business. So if we are thinking about it in terms of why do we care about this? So gearing determines the firm's ability to meet its commitments in the long term. So if I recall our previous video, and so I think back to the video on the liquidity ratio, which was the current ratio, that was very much about short term. So I was looking at the current ratio, which equals current assets over current liabilities. So if I'm looking at this one here, that I'm instead looking at the long term when I look at the gearing ratio. So if I'm looking at this a little bit further, that I'm trying to figure out how solvent is the firm. And solvency here is whether it is able to pay all its debts or claims on time, or whether it's taking a long time to figure that out. So that for us, gearing is really useful because it's telling us how likely is it that a business can pay its long-term debts and then figure things out into the future. So if I'm thinking about a more formal definition of gearing, so it's also known as leverage, all in the debt kind of description, it's the proportion of debt and the proportion of equity that is used to finance a business. So again, if I'm looking at gearing, I'm looking at how much debt and debt coming from outside of the business, how much equity, money from the owners, is used to finance a business. And this will become clearer when we look at the actual ratio. Before we get stuck into the ratio, I think it's worth talking about how much gearing is good. How much gearing should a business have? So that essentially, the more gearing a company has, a higher gearing ratio means that it's more at risk. So if we make this a bit simpler, this seems very jargony to me, so that what we're saying is that the more gearing a company has, or a business in our context, the more debt it has, which means essentially the more risk it's got. If things change, if interest rates go up, if business conditions go differently, this could all be a problem. So in general, a higher gearing ratio, that means that a company might be less solvent, less able to pay back its debts, exposed to more risk because it's got all this money that it owes. Maybe it's more vulnerable to an economic downturn because if the economy slows and less people buy their products, maybe they won't be able to pay back that debt. And they're more vulnerable to a rise in interest rates because if interest rates go up, that's going to increase the size of their debt repayments, which could be a problem. So let's have a look at the ratio itself. So what we do is if we are measuring gearing, we use the debt to equity ratio. And basically, it shows you debt to equity because you can see here on the top, we've got total liabilities, which is the total debt, and then total equity, which is, well, our total equity. So we are actually seeing in the ratio, we've got debt over equity. We are looking at the relationship between the two. So if we think a bit more about this ratio, what we are seeing is we are seeing this idea about how a business is being funded. So the business needs money, and we're looking at how is it that this money is going into the business. So what we're saying is okay, well, how much debt is going into the business versus how much equity. So it shows us the level of debt in the business, total liabilities, compared to the amount of money that's been put in by owners, which is total equity. So if we think about what this looks like, let's say that in terms of the debt to equity, let's say that it was 80% and then it goes to 120%. So if we think about the ratio, because we've got debt on the top and equity, that if this becomes larger, that this business is taking on more debt. Okay, so this is the 2012 Business Studies HSC. I left the wrong question in, but that's not a problem because we'll do the right question over here. So we can see here we've got the balance sheet and we've got pretty typical balance sheet here. So let's say that we are trying to figure out the level of debt to equity for this business. So let's say the question says calculate the gearing ratio for this business. And say, okay, cool, we can calculate the gearing ratio, that's fine, equals the total liabilities, so the debt, over the total equity. So in this question here, we're thinking about, okay, what are the total liabilities? So I can see, what is the total equity? Let's start with that. Owner's equity, the total amount is 34,000. And then if I think about total liabilities, that here I've got 14 and 20. Oh, okay, so that's 34,000. So that equals 1. So in terms of the debt to equity in this situation, that I have the same amount of debt to equity for this business. So we are not largely indebted compared to the amount of equity in the business. So let's think about another example. This is a little bit more tricky, but I think we can work through this. So this is from the 2015 Business Studies HSC, and all of the sources, the links for these exams will be in the description. So this is an 8-mark question. You can see here the second part, part B, is worth 5 marks. So the question here says, discuss the gearing of Andrew's discount tires. So a lot of things in a short question. So if we look at the format of the question to start with, when I get this directive term discuss, that what I'm talking about is what is the for and against for this business in terms of gearing, because of this discuss term. And that with the gearing, okay, so I think about, gearing, so I'm thinking about debt to equity, because that's telling us about the level of debt in the business to equity, and I know that that is total liabilities over total equity. So now I have to work this out and then sort of think about, well, what does this all mean? So if I look at the situation, so I can say, okay, so total liabilities, so I've got current liabilities, non-current liabilities. So I've got 2, 1, and 5 here. And then we'll just put a different color here. In terms of owner's equity, we've got 16,000. So on this side, we don't really need to focus ourselves on the assets for this question, but we do need to focus on this element, Andrew's gearing. And this isn't an example response, it's just things that you need to include to try and get that 5 out of 5. So if we look at the total liabilities here, I've got 8,000, because I'm just adding up all of these things, and then that is over 16,000. So that is 0.5 or 50%. So if I'm thinking about this situation, I'd be like, well, how do I know whether this is good, bad, whatever? So if I look at it here, it says the industry average is 80%, and they've helpfully given us the formula there as well. So if we are doing our analysis in looking at the fors and against, is that if we think about it in terms of for, right? So if we think about the for, the gearing ratio is below industry average. Andrew has less debt compared to the competitors, which means he could have less risk. So that if circumstances change and the economy goes poorly, or if interest rates move upwards, then Andrew might be in a better situation than the competition. But if we're then thinking about, well, what would be a negative? So we have to think a little bit about it. But one of the things that I would encourage you to think about is that if a business has less debt, then that means that it has less finance. So if I have less debt, I have less finance. I have less money available to me. So what it could mean is that Andrew is less able to take advantage of opportunities, such as expansion, and that what this could do is this could leave him at a competitive disadvantage. So that Andrew has less debt, which, yeah, okay, maybe less risk, but also maybe can take advantage of less opportunities. Okay, so this is the story in terms of gearing with those worked examples. If you've got any questions, just leave them in the comments. And as always, thank you very much for watching, and also just watch the other ratio videos. They're all linked in the show notes once they've been done, so you can check out all the things you'll need to know. Anyway, thanks a lot. Bye-bye.